While most high earners are getting crushed, paying 40% or more in taxes on their investment gains, there's an asset class that lets you generate significant returns while paying potentially no taxes on the income that it generates. I'm talking about real estate, but not the way that most people do it. Most wealthy families either avoid real estate altogether because they think it's too hands-on, or they invest in it wrong and miss out on the massive tax advantages that make it so powerful for high net worth investors. My name is Samuel Harnish, and I'm the founder of Quantitative Financial Strategies, where we help families with significant wealth build tax-optimized portfolios. And real estate is often the secret weapon that ties everything together. The reality is, for taxable investors in high tax brackets, real estate offers tax benefits that no other asset class can match. And I'm not just talking about appreciation or cash flow. I'm talking about strategies that can turn profitable real estate investments into massive tax deductions. Today, I'm going to show you why real estate is the ultimate tax shelter for high earners, and how sophisticated investors structure their real estate investments both for the returns and the tax benefits. Because if you're paying high taxes on your investment income and not using real estate strategically, you're leaving enormous amounts of money on the table. Let's start with why a traditional approach to investing in real estate misses some of the biggest tax benefits that can come with the asset class. When I was working at a multifamily office, the only way they invested in real estate was in the form of publicly traded real estate, and that's through something called a real estate investment trust, or REIT, and that trades on an exchange just like a stock or ETF would. This is the starting point for most people, but it's not my preferred method of investing in real estate, and there's a few reasons why. Number one, it significantly reduces your opportunity set. 93% of all commercial real estate is private, not public. So you're only able to look at 7% of the market when you're investing publicly. Number two, it's way more volatile. Public REITs have even more volatility than the stock market, and they can be absolutely terrible during market stress. So if you look at 2020, they crashed over 40% from peak to trough. And part of what we're looking for when we invest in real estate is diversification benefits. But when you look at public REITs over the past 20 years, they've had a correlation of about 0.8 with the stock market, whereas private real estate has had a correlation of 0 with the stock market. So it's actually much more diversifying if you can invest in private real estate over public. Part of that is just due to the smoothing of returns in private real estate, but I personally like that because you get to remove a lot of the sort of emotional noise and volatility that comes with public markets and just focus on the real estate properties themselves. And third, and probably the biggest for me, are the taxes. Public REITs are unable to pass depreciation on to the investors, and so you're going to be left paying income taxes on the distributions from those shares. A private REIT can actually utilize depreciation to give you tax-free income, and a traditional real estate private equity fund can pass the depreciation through to you in amounts larger than just to offset the income it's paying you. So you can use all of that paper loss to offset other forms of passive income that you have, even outside of the investment in that fund itself. And so for this video, I'm going to assume you know what a cost segregation study is and what bonus depreciation is, but if you're new to that, I did make a video previously on it walking through it in greater detail. When we talk about depreciation from investing in real estate, there's two big clear distinctions that need to be made. One is if it's active, so the depreciation or paper losses in real estate that way can be used to offset active income that you have, whether that's from your W-2 or 1099 income from your job. On the other side, you've got passive. Passive losses can only be used to offset passive income, which would come from other real estate investments or even sometimes other kinds of income producing credit strategies. It depends on how it's structured. And that split between active and passive is clearly defined by the IRS, and they want to see, are you materially participating in the activity? And if that's the case, then you're on the active side, and if you're not, then you're on the passive side. So you've got two main ways you can qualify real estate investments as active. One is the short-term rental strategy, which means the average stay is 7 days or less, and you spend more than 100 hours a year managing the property, and no one else is spending more time managing the property than you are. So it's not like you can just hire a property manager to do your short-term rental and you just sit back. If you do that, the IRS is going to say, nope, that's passive. The other one is for long-term rentals. You need something called real estate professional status, or REPS, and you got to meet two things to qualify for that. First, more than 50% of your work needs to be spent in real estate activities, whether that's development, construction, rentals, property management, etc., and you spend more than 750 hours a year materially participating in those real estate activities. Now, here's a little wrinkle that's pretty cool, and it's my personal dream, is to have a wife that takes on managing the rental properties and gets real estate professional status, because then you could could classify the depreciation from those properties as active, but the IRS lets you, if one spouse has reps, those losses can be used to offset ordinary active income that the other spouse makes in their job, even though the other spouse isn't a real estate professional. So let's say in my job, I make $1 million and it's just straight up W-2 income. Well, if my wife is managing a few properties and the depreciation from that year is $1 million, you're able to take that deduction against my income, and our taxable income for the year would be $0. And this strategy can be so powerful, but it's not simple, and you want to make sure you're executing it correctly. Tax optimized real estate investing isn't something you can just jump into without proper structuring and planning. It requires significant capital, the right legal entities, IRS approved property management systems, and coordination with your overall tax strategy. At QFS, we work with families who have $5 million or more in investable assets, and real estate is often a key component of their tax optimized portfolio. We help coordinate real estate investments within their broader wealth management strategy in order to maximize returns and tax benefits. Obviously, this approach requires the right amount of assets and circumstances to make it economically viable, and we can't work with everyone. If you're in that category and you want to explore how real estate might fit into your tax optimized portfolio, go ahead and use the link in the description. But let me show you how sophisticated investors actually structure these investments. So if you're looking at investing in real estate through a tax-aware lens, what you're going to want to find are properties with high building to land ratios, because land isn't something you can depreciate. You're also going to want to find properties that have a decent amount of features that aren't part of the structure, because structural components can only be depreciated on that straight line schedule. It's the elements that fall under cost segregation studies that can all be written off in the first year. So typically for a good fit for a multifamily investment for a taxable investor, you're looking at around 30% of the property's value you should be able to take in a deduction in the first year when you invest. And if you need an even bigger deduction, there's things like car washes and gas stations that are actually able to give you sometimes as high as 80% of the value in the form of a deduction in the first year. And the reason for that is the structural components of those assets tend to be far lower than, say, for a multifamily property. And so with 100% bonus depreciation coming back, those are other assets that people are looking at acquiring when they have large income years and they need a big deduction. So if you're going to go the direct sort of active route in your real estate investments, you're going to want to make sure that you're keeping a log book that you can show the IRS in the event that you're audited. And you also want to be working with a CPA that understands how to file all of this correctly. And that's something we do with our clients, working with a CPA. So we're both just holding your hand, walking you through the process to make sure you're doing things correctly so that you can get that big deduction on your income taxes. And for most people I'm working with, they don't want to take the time, energy, or risk of managing their own individual rental properties. And so we'll usually go the fund route, and we'll work with different managers that take care of everything. And we're able to get diversified across thousands of different real estate properties across the US. They can still pass depreciation to us. And then depending on the manager we work with, we have some that have passed over 40% of whatever you invest in the fund in a deduction in year one. It's just that's going to get classified as passive. We want to make sure we understand what your tax pain points are. Now, if you don't want to manage real estate properties, but you really do have a need for an active deduction against your ordinary income, that's where we'll use the tax-aware hedge fund strategy. And that produces the same result or outcome that people are after with the real estate professional status or short-term rental without all of the headache and hassle that comes with those. And I've done a couple videos on those if you want to take a deeper dive into how those work. When I'm reviewing how people are currently investing in real estate, these are some of the top things I see people doing wrong. They're focusing on the IRRs and the pre-tax returns, and oftentimes it'll be shorter time horizons of, let's say, 3 to 5 years that they're buying a property, working on it, and then flipping it. Problem with that is you're completely getting rid of all of the tax benefits that are so attractive about real estate, because any depreciation you did is just going to get recaptured. You're going to trigger a capital gain when you sell the property. And so if you had, let's say, made $1 million off of doing some sort of deal like that, for the people I work with, they're in high tax brackets, you might lose a third of that, and then you're starting over having to invest and build from there. A much more effective way to go about investing in real estate is buy good properties and hold them for at least 10 years. That way you can take all of the depreciation, make all of your rental income tax-free. You might even be able to offset other forms of income you have outside of just that real estate investment. And then when the depreciation has run out, that's when you can do your 1031 exchange. You exchange into a bigger property, you avoid the capital gains, and you actually now have new fresh cost basis, which you can start depreciating again. And that's the way that the wealthiest families who pay taxes taxes, they invest in real estate over decades, and that's the optimal playbook for taxable investors. Just invest in real estate over decades. Keep doing depreciation, keep doing 1031s, defer your tax liability. You can create liquidity in the form of cash out refis. That's not a taxable event. And you can build multi-million-dollar portfolios of real estate with no taxes along the way, all leading up to passing it to your heirs and getting a step up in basis. And there's no asset class that has all of those different features that are so attractive from a tax standpoint in the way that real estate does. So if you're looking to invest in real estate, be realistic about what you're able to take on. Do you want to be direct in managing your own properties? Would you be better off being more diversified and having a professional fund manager take care of it? What is the classification of your taxable income? Do you have a lot of passive income? Do you have a lot of active income? Do you have access to a tax-aware hedge fund that can help you with the active income? Because you really got to want to manage real estate if you're going to go the direct route. And if you're doing it just for tax purposes, there are other strategies available that aren't going to take up all of that time to give you the same deduction you're after in the first place. And what does your current portfolio look like? Are you already fairly illiquid? Do you already have a lot of real estate exposure? It doesn't really make sense to be adding more to it. And if that's the situation you're in, maybe you want to diversify into other asset classes. And for us, there isn't a single asset class that we don't have access to. And so for a QFS portfolio that's fully diversified, we'll be invested across public stocks and bonds, private equity, credit, infrastructure, real estate, hedge funds. And those different strategies have different correlations with one another. And what it does is it makes for a much smoother return stream over your life. And real estate can be one of the best parts of that asset allocation if you're doing it correctly. It's not for everyone, and it's definitely not a get-rich-quick scheme, but for high-earning taxable investors that know how to use it properly, real estate can be one of the most powerful tools, both for building wealth and reducing taxes. The key is approaching it strategically with proper structure and as part of a coordinated tax optimization plan, not a side hobby or emotional investment. If you're a high earner who's been curious about real estate but didn't know how to integrate it into your current investment strategy and tax planning, click the link in the description to book a consultation call. We can talk about your specific situation and where real estate might make sense as part of your tax optimized portfolio. Make sure to subscribe for more videos on sophisticated investment and tax strategies. I'll see you in the next video.